Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Asian stocks extend a US tech sell-off on fears about slumping chip demand. Dutch giant ASML plunges the most in 26 years as order bookings tumble and guidance is cut. LVMH slumps. The luxury giant sales drop for the first time since the pandemic as demand cools in China. And Donald Trump dismisses criticism of his tariff plans in an interview with Bloomberg just 3 weeks out from the election.
To me, the most beautiful word in the dictionary is tariff, and it's my favorite word. It needs a public relations firm. There are no tariffs. All you have to do is build your plant in the United States, and you don't have any tariffs.
Happy Wednesday. So the headwinds from the semiconductor sector with ASML in the eye of the storm on this one, rippling across the global markets and offsetting the gains that came through from the banking sector with really decent results coming through from the likes of Goldman Sachs, Bank of America and Citi yesterday. For now, though, the focus is on the chip space and headwinds, particularly around the industrial and auto parts of the demand structure. In Europe, European futures then pointing lower by 0.6% and expect the semiconductors in this region to be a further drag in the session today. The FTSE 100 here in the UK currently down 0.1%. S&P futures pointing to gains of 0.1% after losses of around 0.8 yesterday. Yes, there was a sell-off by the end of the close on Wall Street. Nasdaq futures currently higher by 0.2% after the Nasdaq 100 dropped around 1.4% by the end of the close yesterday. Let's flip the board and look cross-asset then. You have some inflation data out of the UK, 7 a.m. UK time, expected on a core basis to ease. To what extent will that play into and lock in a further cut from the Bank of England in November? So we keep an eye on the pound at 130. 4.03 right now is what the 10-year is yielding stateside, still passing comments from FOMC officials. Brent $74 a barrel, up 0.4%. Israel says it will decide how it retaliates against Iran. Gold at 2,666 per troy ounce on the LS metal, up 0.2% so far in the session. Let's cross over right now to Singapore. Avril Hong standing by for a check on the Asian markets. Avril.
Yeah, Asia markets in a pretty somber mood. At least that's how they started the day. I mean, what do you expect when you see a tech sell-off in the US? That is, after all, the sector that's been driving the rally. When it turns tail, the pain tends to spread. And we're seeing a lot of the other sectors on the region's benchmark down today as well. MSCI Asia Pacific at its lowest level in about 3 weeks. The tech-heavy gauges are among those that are taking a beating, particularly bad bleed on the Nikkei. I think the halt in the weakness in the Japanese currency can't be helping things along. It is, after all, this questioning about the AI rally. We are getting a bit more good news. I want to say in the past 15 minutes or so, hearing from the Hong Kong Chief Executive Policy briefing and hearing how they're going to be relaxing some of these mortgage rules for some homes. And as you know, that has been a pain point of sorts, especially with everything going on in the mainland, weak demand coming through from that front as well. And we are still seeing a bit of impatience growing as far as China's stimulus measures and the filling of the blanks is concerned. We are seeing investors waiting out for the housing ministry briefing that is due tomorrow. We'll also hear from the likes of the PBOC, and hopefully we get more details on any property support measures. In the meantime, we're seeing these double-digit gains among Chinese developers listed in Hong Kong. They are running ahead of that. Digging a little bit deeper into what we're seeing in some of these chip names as well for ASML, the TSMC, SK Hynix stocks are the biggest drags on the gauge for stocks in the region. These are, of course, ASML's customers for this part of the world. But what is really interesting to see is also these almost double-digit declines on the likes of Lasertech, Tokyo Electron. Some analysts have pointed out that this is because of how high Japanese equities had already been running. So it gives you a sense of how far they've gone and how far they've coming down. Tom.
Hong in Singapore, thank you very much indeed. In terms of the shockwaves rippling across the Asian market from this downgrade coming through from ASML, concerns amongst clients, customers, but also suppliers as well to that maker of lithography machines. And as Avril mentioned, Asian stocks then are part of that sell-off, and part of the story is, of course, around what's happening in the chip space. Worries that the industry maybe is running further out of steam. Dutch giant then ASML cutting its outlook after booking only just half the orders expected this quarter. Let's bring in our tech reporter, Annabelle Drulers, with the details. Annabelle, the results came through a day early. We're still trying to find out exactly why that was. So no doubt questions to executives on the call later today, I think 2 a.m. UK time. Talk us through what we heard, what we saw, the key numbers from these results.
Yeah, well, as you said, just some of the highlights there. I mean, I think the big concern really was just how badly they missed in the third quarter, because you were expecting, or analysts had been expecting, around $5.9 billion in sales to be booked, and actually they came in just around the $2.8 billion mark. So a huge miss there on what analysts had been expecting as well. The guidance, what they're seeing for 2025, that was lowered. A share price reaction, of course, you're mentioning, and it's flowing well across into Asia today. And as you said, results a day early. Something else that really surprised the market here, the company saying that it was a technical error, or prematurely because of a technical error. So certainly a lot for investors to consider here, and it really just does point to that sort of two-speed recovery that we're seeing in the chip space more generally, because on the one hand, you've got still all of that excitement around AI chips that's persisting, and that strong outlook we're seeing. But at the same time, you've got the more legacy chips that are used for things like consumer electronics and automotives, and that is still really finding its way out of the industry slump.
And that distinction is really important, Annabelle. I'm really glad you broke that down, because Nvidia down 4.5% or close to 5% by the end of the close yesterday on some levels doesn't make sense, because they are the maker of these AI accelerators. And as you say, all the evidence suggests that demand is still there. Industrials, autos, shock horror, the demand is slumping. We know that when we look at the European car space. That should not come as a major surprise. But you're absolutely right to point out that distinction in terms of the segmentation of the chip space. Talk to us about the China part of the story for ASML and the broader read across.
Well, this is also something that really feeds into the concern around the stock. And I think something that is not perhaps being heavily pointed out is just how much stockpiling we saw of ASML's equipment ahead of the restrictions taking effect, because there's lots of different geopolitical tensions that are facing ASML in particular. This is a company, as you mentioned before, it produces EUV machines. This is the machines that are really critical to producing the most advanced AI chips out there. Now, if those are restricted from being sold to China, there's also that question around the serviceability of those machines, and that's playing into it as well, because these machines need a lot of maintenance every few months, definitely at the year mark. And so there's that question of how much Chinese companies were trying to get ahead of these restrictions taking place, the concerns around the serviceability as well, and that could perhaps be feeding into these numbers.
OK, excellent context and breakdown. Bloomberg tech reporter Annabelle Drulers on the ASL numbers and the broader read across to this chip sector. Annabelle, thank you. And this ties, in fact, when we talk about US restrictions, to, of course, the politics of the US as well, to some extent. Donald Trump has been telling us and talking to us about his tariff plans. He's defended his plans, by the way, to dramatically increase those tariffs, and partly, of course, on China, and seek greater influence with the Federal Reserve if he returns to the White House. The Republican presidential nominee has been speaking to Bloomberg News' editor-in-chief, John Micklethwaite.
We're all about growth. We're going to bring companies back to our country. To me, the most beautiful word in the dictionary is tariff, and it's my favorite word. It needs a public relations firm. I had a very good relationship with President Xi, and a very good relationship with Putin, and a very good relationship with Kim Jong-un.
You worry about that?
The dollar is so secure. Your reserve currency is the strongest it'll ever be. I think that if you're a very good president with good sense, you should be able to at least talk to him. I don't say make the decision at all. Take a look at Detroit. Take a look at our cities. We're a developing nation. We have to develop more than they do.
OK, let's bring in Bloomberg's Bill Ferries in Singapore for some context around this conversation, of course, with the Republican nominee. Trump defending then a slew of these economic proposals, as we heard, including, of course, tariffs and how he thinks about his relationship with the Fed and the Fed chair. What do we know, Bill, about the costs of Trump's plans as we currently understand them?
Well, I think if you ask Donald Trump, he will say most of his plans will largely pay for themselves, or that he'll get enough revenue from these tariffs he's proposing to offset expenses elsewhere. I think most economists, the vast majority, really disagree with that. They say, a 10% across the board tariff is going to have a huge impact on inflation, on everyday costs that Americans pay. But a Bloomberg analysis done several weeks ago, and that was actually before Trump introduced some additional tax proposals, that calculated a cost of about $10 trillion over the coming decade. I think the Peterson Institute has since updated that to as much as $15 trillion over a decade. So potentially huge costs. Donald Trump, not surprisingly, not buying into that argument. He said there in that clip, we're all about growth. He thinks the revenue and the boost to the U.S. economy will overcome any of those kind of shortfalls.
Yeah, and we also heard him taking a tougher line on U.S. allies, the European Union, in the mix there, than he did against some of their adversaries, like North Korea and Russia. And he took another shot at the EU. We know the EU is not sitting idly by this time. They don't want to be caught out by a Trump presidency. What do we know about the details, Bill, in terms of how the EU is preparing for potential Trump tariffs if, of course, he wins?
Yeah, I think the EU, along with many countries, hedging their bets on that November election. The EU coming up with a list of goods and services it could potentially target if Donald Trump wins the election and follows through on his proposal to put in that 10% tariff or higher in some other places. Now, we don't know the exact list of goods, but we do recall back from Donald Trump's first term that the EU went after some politically potent symbols of the American economy. They added tariffs on things like Harley-Davidson motorcycles, Levi Strauss jeans, and those kind of things. I would expect a similar list put together if Trump wins, just kind of held in the back pocket to see what he does on Election Day. But really the goal would be to make it a little bit more politically painful for the Trump administration, if it takes office, to carry through on some of those promises.
Bill Ferries in Singapore, thank you very much indeed. Now, we've been talking about the Fed and how Trump thinks about the Federal Reserve. At the Fed, meanwhile, just in the last day or so, we've been hearing from Raphael Bostic. He expects US growth to slow in 2024 but remain robust. Meanwhile, Mary Daly says the central bank must stay vigilant as inflation and the labour market cool. For more, let's bring in Bloomberg's Valerie Teitel. Valerie, do we have any more clarity then in terms of what we've been hearing from these Fed speakers as to the next steps for this Fed? How has the market adjusted, if at all?
Well, Tom, they're still very much using the same lines as they have been, using this B word of balance. This is from Mary Daly yesterday when she's talking about the risks to inflation and unemployment, saying to the risks their goals are balance. And she also went on to say that they must stay vigilant to guard growth. Sounds very much like the Fed put is still there and alive. But I want to draw your attention to one survey released by the New York Fed yesterday on credit card delinquencies, Tom. They showed that the odds of missing a debt payment in the next 3 months has risen over the last 4 months on a steadily incline. We are now seeing a 1 in 7 chance that a U.S. consumer sees the risk of missing a payment in the next 3 months. So a bit of a forward-looking expectations when it comes to the debt delinquency story and the health of the U.S. consumer.
OK, Bloomberg's Valerie Teitel with a warning maybe there, at least on some segments of the US consumer. Valerie, thank you. Coming up, LVMH talking to the consumer, but this time in China. LVMH sales falling for the first time since the pandemic. We're going to look at why the luxury goods maker is failing to catch the eye of Chinese consumers. They're running out of money, basically. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, LVMH fell as much as 10% in US trading after the luxury goods giant missed estimates with its third quarter earnings. Lower Chinese demand led to sales falling for the first time since the COVID-19 pandemic. Very pleased to say we're now joined by Bloomberg's Asia Global Business Managing Editor, Rachel Chang, who of course has her finger firmly on the pulse of how the Chinese consumer is adjusting. Not a big surprise on some levels, Rachel, that there is softer demand out of China for luxury goods, but the numbers within the mix for LVMH causing quite a lot of angst for investors.
Right, definitely so. I mean, we've seen bad numbers for luxury brands in China for most of the year, but this set of results was such a shock to the market, and I think will continue to play out as Europe wakes up because, things really seem worse than expected. For example, the drop again in China revenue, that was expected. That happened last quarter as well, but there was a drop lower than estimates in the really important fashion and leather sector for LVMH. That hasn't shown such bad results since the pandemic. So since the world went into lockdown in 2020. This is as bad as then. And again, last quarter we saw some bright spots. So for example, Japan was doing pretty well for LVMH last quarter because we saw the Chinese tourists going to Japan to buy their bags instead of in China. But this quarter, we're not even seeing Japan hold up. We see Japan going down as well for LVMH. So essentially, there are no green shoots, no bright spots for them anywhere at all in the China story. And so, people are really panicking now.
Well, so that leads to the obvious question as to what next then for luxury brands in China. Is this as bad as it gets, or is there more pain on the horizon, do we think?
So that's really the question that people want an answer to. So now all eyes are going to turn to Hermes next week because Hermes really is that one luxury brand that's still done really well in China throughout because they are, right at the top end, really the billionaires, people who are not really suffering. They don't discount. They're very exclusive. So if Hermes is starting to report weakness as well, that means weakness at that very top end of the Chinese consumer. Then, there's really going to be panic. But essentially, now in all the European luxury houses, that is starting to be the question of whether all of that massive investment they made in China, the bet on the Chinese consumer, whether that is not a short-term problem right now, but really that bet was the wrong bet, that in the long term, the Chinese consumer is not actually going to be as big a part of the luxury story as previously thought.
Rachel, before we let you go, does that suggest that some of these companies might be looking at restructuring their operations in China at price cuts? Do we have clarity on how these executives are thinking about how they adjust their businesses? And is there an expectation that maybe in the months ahead, the stimulus and the support coming through from the Chinese government could turn things around for the Chinese consumer?
I think for the stimulus anyway, disappointment has set in really quickly. We're not really seeing any efforts to boost the consumer. We're not really seeing Chinese consumer confidence rise on the stimulus. And for the fashion labels, for the luxury houses anyway, I think some of that deep conversation is already happening about pulling back on the investments that they've done in China. For example, we just reported that Tiffany's closing its Shanghai flagship, halving the size of its Shanghai flagship store. A lot of big plans, in the past decade for really going big in China. A lot of that is now being pulled back. And probably those long-term strategies will have to be withdrawn. We know that they're going to be looking at other regions, for example, the Middle East, to prop up some of the growth that they're no longer expecting from China. So this is really a big turning point for the luxury industry.
Yeah, that's really, really interesting context, isn't it? I remember going to that Tiffany store when they first opened it, all bells and whistles, and very excited about it. But now they're potentially cutting that store space. Wow. OK, Rachel Chang, thank you very much indeed for the context as we look ahead now to Hermes, as Rachel says, in terms of the next litmus test in terms of luxury and exposure to China. Talking of China, Shein is said to be adding more banks to help arrange its potential listing in London. Sources say Barclays and UBS have been picked as book runners for the online fashion retailer's IPO. We're told the listing could happen as soon as early next year, valuing the company at around $65 billion. It started in China. It is now, though, listed at least Hong Kong. It's Singapore-based, and headquarters is Shein right now. But originally, its origins were in China. In terms of the day ahead, we have data crossing out of the UK on the inflation story, 7 a.m. UK time. It is the CPI print, core inflation expected to edge slightly lower. We're expecting to see a core inflation print of 3.4% on a year-on-year basis, down from 3.6%. Will that further cement that cut that is being priced in by the markets from the BOE in November? So the inflation data we will break for you live, of course, 7 a.m. UK time. On the earnings front, we had some decent numbers coming through from the likes of Goldman Sachs and Bank of America yesterday. The focus switching to Morgan Stanley, 12:30 p.m. UK time today. Will Morgan Stanley be able to repeat the beats that have come through from the likes of JP Morgan and Goldman? Will it be a similar story for Morgan Stanley, particularly when it comes to the investment banking and trading parts of that business? And at 7:40 p.m. UK time, the ECB President Christine Lagarde will be speaking, and will be across that for you as well, as markets increasingly lock in a more aggressive cutting cycle from the ECB. Of course, that decision coming on Thursday from the European Central Bank. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Estelle Brachlianoff is the CEO of the world's largest environmental services company, Veolia. Brachlianoff has been at Veolia for almost 2 decades. This is interesting. And at the helm for 2 years, helping to guide the company's global growth. She told Francine Lacqua on Leaders with Lacqua Goes Green about their AI prospects, I believe. Take a listen.
AI can be part of the solution and is a problem at the same time. So if I start with the problem, AI, data centers, they consume a lot of energy and they need a lot of water. So actually we're providing services to the companies which are doing AI, and it's a growing market. On the other side, AI can benefit ecological transformation and saving water, saving energy, saving CO2 and so on and so forth. And can make a company like Veolia more efficient.
And if you want to, you can watch the full interview on Leaders with Lacqua Goes Green, airing 9:30 p.m. New York time tonight in the US, 6:30 p.m. London time on Thursday. Tune in for that interview. Now, Boeing shares advanced yesterday after the plane maker took a step towards raising up to $25 billion in bond or share sales to help withstand a prolonged strike. It's also secured a $10 billion credit agreement with US banks. The funds could help Boeing improve its bargaining position with striking workers who want higher wages and a reinstatement of pensions. And to the retail space, Adidas has raised its annual profit target for the 3rd quarter in a row, thanks to the sustained boom for retro sneakers like the Samba and more sales from its shrinking stockpile of Yeezy footwear. The German sportswear company now expects to generate operating profit of around 1.2 billion euros. Lots of foot shots on TV right now, up from the previous forecast of around 1 billion euros. A change in fortunes at Adidas. Let's check back in on the Asian session with a particular focus on the tech space, semiconductors. This was the surprise, the shock, arguably, that came through from ASML with its earnings, of course, yesterday, coming out a day before they were meant to. Apparently a technical glitch to blame. But more importantly, it was a cut to the guidance for 2025 and a shipment of orders at less than half the expectation. So the ripple across the semiconductor space being felt from some of their suppliers and customers in Asia. Coming up, we're going to get more details on ASML. Stay with us. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Asian stocks extend a US tech sell-off on fears about slumping chip demand. Dutch giant ASML plunges the most in 26 years as order bookings tumble and guidance is cut. LVMH slumps. The luxury giant's sales drop for the first time since the pandemic as demand cools in China. And Donald Trump dismisses criticism of his tariff plans in an interview with Bloomberg just 3 weeks out from the election.
To me, the most beautiful word in the dictionary is tariff. And it's my favorite word. It needs a public relations firm. There are no tariffs. All you have to do is build your plant in the United States and you don't have any tariffs.
OK, let's check in on these markets then. The headwinds coming through from the chip sector on the ASML story. Certainly we've seen some downside pressure on Asian semiconductor suppliers, equipment makers and customers on the back of that guidance cut coming through from ASML and a big miss in terms of the orders. The ripple effects are being felt in Europe. European futures down 0.7%, and the technology sector will be firmly in focus as a result of that. FTSE 100 currently pointing lower by 0.2%. There's a bit of upside coming through in terms of prices across commodities. Iron ore, copper and Brent. So we'll see how that filters across the basic resources and energy sectors. S&P futures currently up 0.1% after dropping 0.8 yesterday. Nasdaq 100 futures up 0.2% after falling. Nasdaq 100 by around 1.4% yesterday on the softness in technology. Let's flip the board and look cross asset. We've been hearing again from FOMC speakers, Fed speakers, talking about patience, talking about a moderated approach in terms of moving rates lower going forward. 4.03 is what is being yielded on the benchmark US 10-year. The pound in focus ahead of inflation data. That drops at 7 a.m. UK time, 1.30 currently on the pound versus the US dollar. Brent, as I mentioned, up 0.2% in the session at $74 a barrel. And gold up 0.2 as well at 2,667. Now to the earnings story and the details around ASML. So it's a surprise earnings warning from Dutch chipmaker and equipment maker ASML, the most valuable company in Europe. The company telling investors it booked only just half the orders expected in the third quarter. That was a huge shock, of course, to investors who have been in a deep embrace with chip stocks all year amid that AI demand euphoria. ASML shares plunged the most in 26 years, sending other big names in the tech sector also into the red. Let's bring in Bloomberg's Chan Kok then in Amsterdam, who follows this company very, very closely. Chan, thanks for joining us. What are the key takeaways then for you from these ASML earnings that, of course, the report was prematurely released as well last night?
Yeah, thank you, Tom. As you mentioned earlier, ASML results were scheduled for today, but the company published them early yesterday evening by mistake. They blamed it on a technical error. It was an unpleasant surprise for investors. ASML booked actually less than half of the orders that analysts estimated in the third quarter. And they also cut guidance for next year, which was quite a surprising slowdown for Europe's most valuable company. Now, they cited a few delays in chip plant constructions around the world as an explanation. The company will hold a call with investors later today, and we're hoping to get more clues then.
And Chan, what do you think the implications are for the broader chip sector from what we're seeing at ASML?
So any weakness in ASML orders often kind of signals struggles for the wider chip sector. So ASML is the market leader for lithography machines in the world. So we can call it a chip bellwether. It has a monopoly on making the machines that allow companies like TSMC, Samsung, and Intel to produce the most advanced chips that power everything from Apple's smartphones to NVIDIA's artificial trainers. So the big miss is a signal that the chip industry's weakness is set to continue.
Chan, is it your understanding that we can carve out those AI accelerators, that we can at least put to some put to one side concerns about AI chip demand, GPUs from the likes of NVIDIA and AMD, because this is more about industrial demand chips, more about autos chips. Is that the way to be thinking about this? Is there an overreaction in terms of for example, the sell-off that we saw in NVIDIA? Is it fair to say that maybe there's an overreaction there because the demand around AI chips, that maybe ASML isn't signaling there's a downside there? This is about the industrial demand, about autos demand.
Well, you can say that, and you can also see that in the market reaction. NVIDIA dropped, ARM Holding dropped, Samsung dropped, but they dropped a little less than ASML's peers, like Applied Materials, KLA, Lam Research, which plunged 10 to 15%. I mean, so yeah, you can say that and hope for that, but the results sent all semiconductor stocks falling, and the combined market value losses for chip stocks reached more than $420 billion.
Yeah, that's quite the number, isn't it? $420 billion just on the back of this earnings result. So the ripple across was wide and pretty significant. Bloomberg's Chan Kok in Amsterdam with the context around the ASML results. Chan, thank you very much indeed. Now, an ever-growing web of US-led restrictions is curbing, of course, the semiconductor industry's business with China, and ASML has that exposure, of course. Here's a look at these fast-evolving regulations and their impact on some of the world's biggest chip companies.
From NVIDIA to ASML, Tokyo Electron to TSMC, the highest of high-tech chip firms are caught, ever more directly, in the geopolitical crosswinds between Washington and Beijing. The stakes could hardly be greater, with America and its allies increasingly fearful of Chinese advances that might give it crucial technological and military advantages. From design by the likes of ARM and NVIDIA, to equipment from lithography powerhouse ASML, to materials to make the chips from the likes of Global Wafers, and manufacturing by the foundry giant TSMC, the global supply chain winds through many countries considered geopolitical hotspots. US attempts to box in China haven't always been successful. And it's not just the parts themselves. The Netherlands has curbed ASML's ability to maintain its high-end lithography machines in China, which could render some of them inoperable next year. Still, with such vast and intertwined supply chains, slapping restrictions on high-tech is harder than it looks. And then there's the risk of Chinese retaliation.
OK, staying on the chip space, Bloomberg understands that Qualcomm will probably wait until after the US election before deciding whether to pursue a takeover of Intel. Qualcomm wants greater clarity on the new occupant of the White House before deciding its next move because of the impact any future administration would have on the antitrust landscape and America's relationship with China. Donald Trump has insisted that his economic policies will boost growth and bring companies back to the United States, despite economists predicting otherwise. The Republican presidential candidate has said he will offset trillions of dollars in tax cuts by raising tariffs on imports. He's been speaking to Bloomberg News' editor-in-chief, John Micklethwaite.
I had 4 years no inflation. I had 4 years no inflation.
But that was when you had much.
I had 4 years. It's better than that. And Biden, who has no idea where the hell he is, okay? Biden went 2 years with no inflation because he inherited from me. And then they started spending money like drunken sailors. They spent so much money. It was so ridiculous, the money they were spending. They were spending on the Green New Scam. The Green New Scam, the Green New Deal. You know, it was conceived of by AOC +3. She never even studied the environment in college. She went to a nice college. She came out, she just said, the Green New Scam. She just named all these things.
But President Trump, the issue at the moment, the markets are looking at the fact you are making all these promises. Latest one was car loans. You're flooding the thing with giving giveaways.
But we're going to grow.
I was actually quite kind to you. I used 7 trillion. The upper estimate is 15 trillion. People like the Wall Street Journal, who's hardly a communist organization,
yeah, but you don't know.
They have criticized you on this as well. You are running up enormous debt.
What does the Wall Street Journal know? I'm meeting with them tomorrow. What does the Wall Street Journal know? They've been wrong about everything. So have you, by the way. You've been wrong about
You're trying to turn this. You're trying to turn this.
You've been wrong.
No, you're trying to turn this into debate. There are business people. There are business
you're wrong.
people.
You've been wrong. You've been wrong all your life on this stuff. You've been wrong.
Not
Let me
on the
tell you
issue.
about currency. You're going jumping a lot of different subjects.
Whilst you're sticking to the subject very
let's
closely.
stick to reserve currency. That's where you started, right? The reserve currency is under threat because you have Iran, you have Russia, you have China. China's the one that you have to worry about because they want it.
Yeah.
They want to have the yuan be the thing of power. So here's what I'm doing. Again, I hate to go back to it. If somebody says, and I know countries want to get out because they don't respect our leadership, they look at this guy, they say, you got to be kidding, and she's worse than him. By the way, I never thought I'd say this. She is not as smart as Biden, if you can believe it. This is not what, we had 4 years of this lunacy, and we can't have it anymore. We're not going to have a country left. Okay, currency, very important.
Yes.
And if you want to go to third world status, lose your reserve currency. We have to have that. We cannot lose it. If you'll go to third world status in this country because you take a look at the way things are running. If a country tells me, sir, we like you very much, but we're going to no longer adhere to being in the reserve currency. We're not going to salute the dollar anymore. I'll say that's okay. And you're going to pay a 100% tariff on everything you sell into the United States. And we love your product. I hope you sell a lot of it into the United States, but you're going to pay 100% tariff. He will then follow it up by saying, sir, it would be an honor to stay with the reserve currency. That will be like just playing. That's not even chess, that's checkers.
Okay, Donald Trump speaking to Bloomberg News editor-in-chief John Micklethwaite. To the earnings story right now, back to banks. Citigroup shares closed sharply lower despite its traders turning in their best third quarter performance in at least a decade. It was among some of the US banks, big US banks, of course, that reported earnings on Tuesday alongside Goldman Sachs and Bank of America. Later today, we will be getting an update from Morgan Stanley. For more on this, Bloomberg's Charlie Wells joins us now. He's been watching all of the banking earnings story for us this quarter. What seems to be driving some of the upside that's come through for these US banks? What's the secret sauce that they're looking at right now?
It's sort of a Goldilocks scenario, Tom, where the US economy, despite what some people may say, is actually incredibly strong right now. And when you hear these executives talk about the economy, yesterday it was Goldman's David Solomon as well as Jane Fraser, they're talking about a soft landing, a no landing, whatever you want to call it, which is just this sense of optimism that is really driving their businesses. So there's the economy on one front. There's also this lower rate environment we're going into, which is driving more of that investment banking activity. It actually seems like we're reaching something of a trough on net interest income, which of course is a huge and important revenue source for these banks. But also something that really adds to that kind of Goldilocks element is there's still been volatility in really strong markets. So traders have been able to make a lot of money recently. I'm thinking about Goldman yesterday. Their equities traders are on track for their best year ever.
Wow. Yeah, they smashed it, and the volatility certainly helped, didn't it, over the last couple of months or so. How does that all set us up then for Morgan Stanley, who certainly has skin in the game when it comes to trading?
They really do. They've got skin in the game, and they have a tough act to follow. They're the last to report just in a couple hours later today. It's looking like it should be pretty good for them, but expectations, of course, are now even higher than they were before. They're a huge player in the wealth management space. When you think about the market, when you think about equities being so strong recently, that bodes well for them. When you think about investment banking activity picking up across Wall Street, again, at Morgan Stanley, that bodes pretty well.
What about the market reaction to these earnings? The earnings are coming in solid. The market reaction a little bit more mixed.
Yes, as far as yesterday.
Right.
So Citi took a little bit of a hit, but Bank of America, solid report, Goldman, solid report. They ended the day high. But looking back to the year, the market loves financials right now. So they're outperforming the market. They're outperforming the S&P 500. You think, the S&P is up about 21%. Goldman Sachs up 35%. So favorability there, particularly for banks like Goldman that can kind of say, we are positioning ourselves for this next phase that we're entering.
Okay, Charlie Wells, excellent. Thank you very much indeed. We look ahead to Morgan Stanley and those results, of course, which we will break for you live across the programme. Charlie Wells with the details on the bank earnings story. Coming up, Bloomberg Economics expects UK inflation to fall below the 2% target. The data is out at 7 a.m. We're going to give you a preview next. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, the latest UK CPI data is due to drop in just under 15 minutes, about 13 minutes, in fact. Meanwhile, in politics, Chancellor Rachel Reeves is facing growing unease over the scale of spending cuts. She wants to help raise £40 billion to put public finances on a stable footing. £40 billion. For more, we are joined by UK correspondent Lizzie Burden. Lizzie, talk to us about the inflation print and how that could inform where we think the BOE is going to go next.
Well, for the first time since 2021, it's expected to drop below the Bank of England's target to 1.9%, and that's even less than the BOE's August forecast, which was 2.1%. Now, the drop is meant to come down to cheaper fuel and easing of services inflation, and it should give the BOE the green light to cut rates again at its November meeting and keep up this quarterly cadence of rate cuts. Remember, yesterday you had the jobs numbers, and actually a bit of good news in the fact, for the BOE at least, wages growing at the slowest pace in more than 2 years over the summer, even if it's at levels that are higher than the BOE is comfortable with. At least there's a bit of a slowdown. And all of this data is super important, of course, because not only is the BOE data dependent, but you've got the divide between Andrew Bailey dangling the prospect of more aggressive rate cuts and Hugh Pill being a little bit more hawkish. So all eyes on this data, but don't get too excited if it goes below 2%, because the expectation is that actually inflation will go up again by the end of the year, 2.5%, some economists say.
OK, and meanwhile, and you talk about the BOE and maybe the stars aligning for that cut in November, Rachel Reeves under pressure. We know this. The pressure has been really building up ahead of this budget. But now we've gone from, what, a 22 billion fiscal hole to 40 billion? What's going on with this number?
You and I were joking that we'd heard this £22 billion number so many times, and now it seems to have doubled. But if you look into why it's risen to £40 billion, it's because, sources tell us, she wants to raise a buffer so that she can absolutely make sure day-to-day spending is covered by tax revenues. And that means she's going to have to take some of these difficult decisions she's been talking about when it comes to tax spend and welfare savings. They had a cabinet meeting on yesterday morning, and various senior ministers kind of raising the alarm about the savings that they're being asked to make, saying it's not feasible. And what's significant about this is it's not just the usual suspects who have, lots of high capital spending. It's a broad range of departments. But obviously nobody wants to have their budgets cut. Nobody wants to have their taxes rises. So it'll be interesting to see what happens on October the 30th. You've got the IMF, though, warning unless she makes these decisions, you could see an adverse reaction in the markets.
Lizzie Burden, thank you very much indeed. Our UK correspondent, who's going to be, of course, giving the context around that breaking inflation data when it drops in about 10 minutes' time here in the UK. Now to Italy, where the Prime Minister there has revealed that banks and insurers will help to finance the budget. In a post on X, Giorgia Meloni said, quote, "As we promised, there will be no new taxes for citizens. 3.5 billion euros from banks and insurance companies will be allocated to healthcare and the most vulnerable." The Italian Treasury has confirmed the plan but provided no further details. The budget will now be scrutinised by the EU and still needs to be signed off by Parliament. Lots more coming up. Stay with us. This is Bloomberg.
And continued progress towards our goals is not guaranteed. So we must stay vigilant and intentional. What does that look like? Well, it means continually assessing the economy and balancing both of our mandated objectives. And we have to be really focused on fully delivering on 2% inflation while ensuring that the labor market remains in line with full employment.
OK, San Francisco Fed President Mary Daly talking about how they are weighing up on the FOMC, the next decision, of course, for the Federal Reserve. One factor may be the pressure that's coming through on US households. That ties to the labour market that she was describing there. Here's a breakdown in terms of expectations from US households around the risk that they become, or at least are delinquent on some of their debt. And this is divided up by age group, from the youngest in the white line to the oldest segment in the purple line. And you can see all, of course, moving up in terms of expectations that in the future these households could miss payments on some of their debt. So it's a reminder of the pressure, at least on some household segments in the US. Yes, stock markets are near those record levels. So in some segments, US households are doing very well if they have exposure to equity markets. In others, if they have a heavy debt load, there is concern now about pressure and rising risk of delinquencies. We've had 4 straight months, by the way, of increases, and that has been illustrated in this chart. Let's flip the board and have a look at the corporate story of the moment. It is ASML, the earnings dropping yesterday. That was a surprise. The orders coming in the quarter, less than half the estimates, and a cut to the guidance as well. So third quarter bookings below the estimates, coming in at 2.6 billion. The estimates have been for around 5.4 billion, so well below the estimates, lowering the guidance for 2025. The stock plunging, we're going to illustrate that shortly. And they are blaming the early release by 24 hours on a technical error. They're also blaming the softness on weaker demand around industrial chips, auto chips, and some of their big customers like Intel scrapping and sidelining some of their plans and the need to purchase these lithography machines. So we continue to monitor this story in the ripple across. Let's flip the board and see the stock market reaction to this then. The biggest drop, as we said, since 1998, 26 years. And you have to go all the way back to 1998 to see the kind of drop that we saw yesterday in the US listed shares for ASML. And that, of course, points us to the volatility we may see in the semiconductor space in Europe later today at the open, 8 a.m. UK time. Let's flip the board and have a look at, talking of volatility, what's been happening in China. You've had another down day. You do have expectations around maybe more clarity on some of the details around the real estate sector with a briefing on Thursday. We'll be monitoring that for you. But in terms of how things have retraced, at least in the month of October, you can see some of the pullback. This is the benchmark CSI 300, now down 9.4%. And that is a drop from the peak in October. Similar pressure coming through from the HSI. In fact, more pressure over in Hong Kong, down 12% in that period of time. Now, 9:30 a.m. London time, we're going to be speaking with the head of the European Bank for Reconstruction on the largest foreign investment deal in Ukraine. The opening trade, though, is up next. This is Bloomberg.